Welcome to Crypto Journal. Hit like on this video if you want more content about ISO 20022 without promotions or interruptions. And leave me in the comments what you want me to talk about in the next videos. I read every single comment. November 22nd, 2025. Mark that date. Not because of hype or speculation, but because it represents the largest infrastructure migration in financial history. On that day, SWIFT will permanently retire legacy MT messaging formats for cross-border payments. Over 11,500 financial institutions across 200 countries must comply. There are no extensions, no exceptions, and institutions that aren't ready will be disconnected from the global financial system. This isn't a crypto story. This is a financial infrastructure story where certain blockchain networks happen to be positioned at exactly the right place at the right time. Let's start with what ISO 20022 actually is. For decades, banks communicated through SWIFT MT messages, rigid, limited formats that could only carry basic transaction data. ISO 20022 replaces this with XML-based structured data that can carry rich, detailed information in every transaction. Payment instructions now include remittance data, compliance fields, regulatory information, and complete audit trails. This enables straight-through processing, automated reconciliation, and real-time fraud detection. But here's what changes everything. This is mandatory. The European Central Bank migrated Target 2 in March 2023. The UK's SHAPS followed in June 2023. The US Federal Reserve's FedWire completed its migration on July 14, 2025. As of May 2025, SWIFT reports that 72% of institutions are technically compliant. That means 28% are in panic mode right now, racing to upgrade systems before the November deadline. When banks tokenize currencies under the Genius Act and securities under the Clarity Act, they need blockchain infrastructure that speaks ISO 20022 natively, not through bridges or wrappers. Natively. Because every bridge is a point of failure, and every wrapper adds cost, latency, and compliance risk. Only a handful of blockchain networks were designed with this exact scenario in mind. Let me show you the real institutional movements happening right now. Ripple and XRP. In 2020, Ripple became the first blockchain company to join the ISO 20022 standards body. Their RippleNet payment platform has supported ISO 20022 messaging since then. Ripple currently works with over 300 financial institutions globally. In August 2025, 7 major asset managers, including Grayscale, Bitwise, and Franklin Templeton, filed XRP ETF proposals with the SEC. If approved, analysts project up to $8 billion in institutional inflows based on Bitcoin ETF comparisons. In March 2025, Ripple won its partial legal victory against the SEC, confirming that XRP is not a security in secondary markets. The regulatory cloud has lifted. The timing of ETF approvals coinciding with full ISO 20022 implementation in November 2025 is strategic positioning, not coincidence. Stellar and XLM. Stellar processes transactions in 3 to 5 seconds with fees below 1 cent USDC on Stellar has become the infrastructure of choice for remittance providers and payment systems. In February 2024, Stellar launched the Sorobon smart contract platform backed by a $100 million adoption fund. The Protocol 23 upgrade in August 2025 introduced parallel transaction execution, boosting throughput to 5,000 transactions per second. Stellar has working partnerships with Visa, MoneyGram, and Velo. These aren't pilots. These are production systems moving real money. Stellar aims to tokenize $3 billion in real-world assets by end of 2025, a 10x increase from 2024. Stellar's focus on the $63 billion annual US to Mexico remittance corridor positions it perfectly as ISO 20022 becomes the global standard. XDC Network. This is the one most people don't know about, and that's exactly why institutions love it. XDC operates in trade finance, targeting a $5 trillion global trade finance gap. On October 22, 2025, XDC Ventures acquired Quant Network, a trade finance platform originally backed by HSBC, Citi, and Standard Chartered. Quant shut down in 2023 because it couldn't scale. XDC is reviving it with stablecoin integration and blockchain rails. XDC integrates with our 3-Corda, the enterprise blockchain used by over 300 financial institutions. Corda doesn't have a native settlement token. XDC quietly acts as the bridge for real institutional transactions. In February 2025, XDC launched tokenized money market funds from BlackRock, Fidelity, State Street, and a burden through Arcax. In May 2025, XDC partnered with Bits of Business for US to Mexico cross-border payments. Every month, XDC announces institutional partnerships that would send any other token pumping 50%. But XDC barely moves. Why? Because institutions don't want retail frenzy. They want stable, predictable infrastructure. Algorand and ALGO, founded by Silvio Macaulay, an MIT Turing Award winner, Algorand's pure proof of stake consensus enables 10,000 transactions per second with finality in under 4 seconds. Multiple central banks are in discussions with Algorand for CBDC development. Algorand's focus on energy efficiency and regulatory compliance makes it attractive for government projects. In 2025, Algorand captured 66% of the tokenized stocks market share. Their ASIC US tokenized financial products bridge traditional finance and DeFi, ensuring compatibility with existing financial ecosystems while retaining cutting-edge capabilities. Quant and QNT. Quant's Overledger protocol bridges legacy banking systems, permissioned networks, public blockchains, and CBDCs. Quant was designed from the ground up to speak ISO 20022 fluently. When governments, banks, and enterprises need blockchain solutions that work with existing infrastructure, they turn to Quant. Quant has only 12 million tokens in circulation. While other networks measure supply in billions, Quant measures in millions. If institutional adoption accelerates, the mathematics of supply and demand become very favorable. Hedera and HBR. Hedera uses hashgraph consensus, enabling over 10,000 transactions per second with fees near zero. But what really matters is governance. Hedera's council includes Google, IBM, Boeing, Deutsche Telekom, and Standard Bank. When Deutsche Telekom operates validator nodes on your network, that's signal. In March 2025, Hedera launched their RWA accelerator with plug and play. By June, teams were pitching live products to institutional investors. Recently, through Swarm and Hedera Foundation, tokens representing real shares of Apple, Tesla, and MicroStrategy launched. These assets are backed one-to-one and can be transferred in seconds or integrated into DeFi platforms. In late 2024, Hedera launched Stablecoin Studio, allowing banks and governments to create compliant stablecoins. AUDD, the Australian dollar stablecoin, was the first implementation. Wyoming announced its state stablecoin, WSD, will run on Hedera. Cardano and ADA, founded by Charles Hoskinson, Cardano focuses on peer-reviewed research and regulatory compliance. The network is fully ISO 20022 compliant. Cardano's recent USD1 integration on Bitrue is boosting liquidity. Analysts expect ADA to rally toward 90 cents to 1.20. Cardano's emphasis on decentralization, scalability upgrades, and identity solutions position it for institutional adoption. Now here's what nobody's discussing. The Genius Act passed in July 2025, setting federal rules for stablecoins with full reserve backing. This was the regulatory green light institutions were waiting for. The Clarity Act is advancing as the market structure framework, defining boundaries between the SC and CFTC. Genius orders tokenized money. Clarity orders the markets where that money circulates. Together, they create the regulatory framework institutions need. And what happened after Genius passed? Ripple, XDC, Hedera, Stellar, and Algorand all announced partnerships bringing compliant stablecoin infrastructure to trade finance and cross-border settlement. This isn't coincidence. This is a coordinated strategy years in the making. Let me show you the timeline. November 2025, Swift migration completes. Banks that aren't compliant face penalties starting January 2026. In 2026, explosion of institutional demand as tokenized assets move from pilots to production. In 2027 to 2028, global adoption as CBDCs launch and tokenized securities market scale. By 2029 to 2030, this infrastructure is so embedded that its absence would be unthinkable. But here's the critical part. Price is always the last thing to catch up. First comes technology, then institutional adoption, then regulatory clarity, then infrastructure build-out, and finally, price discovery. We're somewhere between infrastructure build-out and that final phase right now. Let's be clear about what we're not saying. We're not promising 100x returns. We're not saying these are guaranteed investments. Markets can stay irrational. Regulations can shift. Technology can fail. What we are saying, follow the institutional money. BlackRock doesn't tokenize funds on networks that don't work. Deutsche Telekom doesn't run validator nodes for publicity. HSBC doesn't revive failed platforms on unreliable infrastructure. When the world's largest financial institutions converge on the same blockchain ecosystems, that's not hype. That's signal. Swift processes over $5 trillion daily. When that flow migrates to ISO 20022 compatible infrastructure, it goes to networks that can handle volume, meet compliance requirements, provide security, and integrate with existing systems. Only a handful of cryptocurrencies were built for this exact moment. This isn't about disrupting banks. This is about providing infrastructure banks actually need. This isn't about replacing traditional finance. This is about upgrading it. When your bank offers tokenized funds, when remittances settle in seconds, when trade finance moves on blockchain, you won't see powered by XRP on the interface. You'll just experience better financial services. The best infrastructure is invisible. Swift dominated not because it was exciting, but because it was the standard. These blockchain networks are positioning to become that standard for the digital era. The November 22nd deadline isn't the end. It's the beginning. It's when theoretical becomes operational, when pilots become production systems, when partnerships become transaction volume. The institutions know this. BlackRock filed their first Bitcoin ETF in June 2023. They launched tokenized funds on multiple blockchains in 2024 to 2025. They didn't do this randomly. They saw the infrastructure transition coming. Deutsche Telekom didn't join Hedera's council for publicity. These are multi-decade infrastructure bets. The retail market hasn't caught up yet. Mainstream crypto media still covers meme coins. But behind the scenes, the world's largest financial institutions are building on infrastructure most retail investors have never heard of. This is the wealth transfer that happens when new infrastructure replaces old infrastructure. It happened with railroads, electricity, and the internet. It's happening now with financial messaging standards. The people who recognized the internet in 1995 didn't get rich buying dot-com stocks in 1999. They got rich positioning in 1995 and holding through 1999. The same pattern is playing out here. ISO 20022 is the infrastructure. November 22nd is the forcing function. These blockchain networks are the rails, and institutions are the proof this is real. Now you understand what most of the market doesn't. You understand why certain networks are absorbing institutional capital. You understand why the November deadline matters. You understand why tokenized RWAs are going from 11.5 billion to potentially 30 trillion. The question is what you do with this information. Do you position before November 22nd when everyone will be forced to pay attention? Or do you wait until institutions announce quarterly results and transaction volumes become obvious? History rewards those who recognize patterns before they become obvious. The pattern here is clear. Follow institutional money. Follow regulatory clarity. Follow technology that works. Follow the blockchain networks that traditional finance is quietly building on. The November 22nd deadline is coming whether you're ready or not. The institutions are positioned. The infrastructure is built. The regulations are clear. The migration is mandatory. And the blockchain networks that can handle this flow are already operational. This is the most significant infrastructure transition in financial history. And it's happening right now, whether the retail market recognizes it or not. Drop a comment below with your analysis. Not price predictions, but your thesis on ISO 20022 adoption and which networks are best positioned for the infrastructure transition. I read every comment. See you in the next video.